Hey guys, welcome back to Basics episode 29. We just finished statistics and now it's test time. So again, if you guys are new here, this is a series where I'm taking my lovely fiance Jessica and teaching her how to trade. We're almost 30 episodes in, so make sure you go back on our channels, and we both have a playlist that has all of the episodes in order, so you can just click one button and watch them start to finish. And again, if you're watching this on my channel, Jessica's has the next one out, and we've finally started her paper trading, so she's going to be doing some videos about that.
I will.
Okay, so you remember all your statistics knowledge? You ready to go?
I think so.
Okay, so again, here's our socials. Follow us both on both of these, please. And yeah, again, if you're here and you want to go over and watch Jessica's channel, you'll get whatever the next episode is in line. So what are some pros and cons of using statistics in your trading? You don't need to get them all, of course, just one. I'll give you a point if you can get one on both sides.
It takes your monkey brain out of it if you can use it.
Yeah.
Right? Like
most
your
emotions,
Yeah.
people will say, right? And even with your paper trading, you've noticed that, there's some bad emotions that bubble up
Sure.
that maybe counter. Okay. So what would a con then be? What would be a negative against statistics?
I'm not sure.
Okay, so we'll give you a half point for that, I guess. So basically the pros is, right, great for handling human biases. There'll obviously be questions on the biases there. It gives you a full understanding of what your trading style is because you've tested everything. You know when you should enter, when you should exit. And then again, just the reduction of stress, right? The cons, the main one is not great with nuance. So whenever you're using statistics, you're basing your trading on things that have happened in the past. So when you're...
I don't know if it's spelled right. Nuance.
I'm sure they'll tell us in the comments if I spelled it wrong. But yeah, so it's like, there's never been a COVID-19 outbreak before. So the data that you may be using may be slightly different. So this is kind of a con for just relying completely on data. So far, you're 50-50. Win rate. So when I'm asking these...
Your R. What's your R?
Right. Well, no.
Frig.
But how is it calculated, and why is it
man.
important? Just roughly, right? So if I say my win rate's 60%, what does that mean?
It means you're right 60% of the time.
Right, which is
Okay.
different from the R, and I'll show you. But yeah, that's...
Oh, R is your profit.
Right, win rate is just how
Right.
much. So
Okay.
it's, right, if you took 10 trades...
Win rate is the amount of money you've gotten, right?
No.
Is that kind of it? Okay.
if you take 10 trades and you were right 6 of them,
Yeah.
you have a win rate of 60%.
Right.
So it's just how much. So it doesn't define what a win is other than a positive trade, right? It could be a positive 1 cent trade, right? It could be a positive 2 cent trade. It doesn't tell you the whole story. It just means that you made money on 6 of your trades. It doesn't talk about how much. And then I just put it don't matter.
Oh, that's right.
Right? This is something I believe strongly in, and I pound the table a lot on, where you can make money even if your win rate's wrong, but you can just see right here
It's all about your risk.
is the win rate.
It's all about the risk.
So profit factor.
That's your R.
No.
Okay.
Profit factor was a little bit more math intensive than that. And remember, it was the number that combined both win rate and how much you made when you were right versus how much you lost when you were wrong.
Okay.
And you still have to...
What?
You're going to try to... Do you remember how it was calculated at all?
I thought you just told me.
No. It just said it combined the two.
No, I don't.
So
remember.
it's... You sum up all of your winning trades,
Okay.
and then you sum up all of your losing trades, and you divide them.
Okay.
So a profit factor of 2, and I have that here, right? So a profit factor of 1.86 would mean that if I made $186, if all of my winners summed up to $186, all of my losers would sum up to $100. Profit generated by winning trades divided by losses generated by losing trades. So the beauty of this is that it combines these two numbers together, where if you're very, very accurate, but risk loss isn't the best, you'll still have a high profit factor, and vice versa.
Okay.
Right? It's just the total of all of the things that made money divided by all of the things that lost money. Again, we're looking for like a 2 is good. It means basically for every $100 you lose, you make $200.
Okay.
All right, now we're into the biases. What's saliency bias?
Oh, you're not even going to give me
What?
a multiple choice? Or like a...
No. We went over saliency bias. What is that bias? Remember, the whole point we do tests, right? And this is something I guess that's important for these guys, is that it is very well known in science now that reviewing information is wildly useless. Like if you read a book and then read the book again, you don't gain that much knowledge on it. But when you have to sit here under pressure and try to pull that information out of your brain, much more connections are made and things just kind of make sense.
I don't remember.
You can think as long as you want.
I don't. It's not going to come to me.
But yeah, saliency bias was basically the bias that talked about how much you value
your own stuff versus someone else's.
No, remember it was the which is more likely to occur.
Yes.
People think that things that occurred recently are more likely than things that occurred a long time ago.
Gotcha.
Right? And that's a bad one when it comes to trading, because people will look at the last 3 or 4 events and say they happened like this, therefore it's a likely chance they'll happen, where maybe the 10 times before those it did the complete opposite, right? And then anchoring. This is the one that actually stuck out to you, the anchoring bias.
That's only because you told them my chicken story.
Different bias.
No.
Oh no, maybe I used 2 examples. Yeah. So
yeah.
What's
it was the website one where like they give you like a bunch of information but like anchor you on one specific thing.
Right.
And then but you don't even notice the other stuff. So like your opinion's formed on like an anchor, one piece of information.
Exactly. And that's what it is. It's how is, depending on where you start somewhere is going to depend on how you look at everything else. Like there's people out there that started trading maybe during 2008, the big financial collapse. Mm-hmm. So they're always just a little bit more bearish on the market than people who started, after that when the market was on this big bull run, right? So their anchor for all their knowledge base is different. But this is it, right?
It,
so they anchor you here, right? And then they hope that from $2.99 to $14 seems like an amazing deal. Mm-hmm. But if they anchored you on free, then $2.99 seems absolutely ridiculous for a price, right? Sunk costs. So this one should be...
It's kind of like throwing good money after bad. Like you're already in it.
Right.
So why? Like I can't get out now. I'm already invested.
Perfect. Yeah. And this is the same. This comes with time. There's a whole bunch of sunk cost bias. So a lot of people, the biggest one that happens in trading, well, the biggest 2 are one, I've already lost $100. Let's just see what happens, right? Which is a horrible idea. The other one is time. Like I spent 20 hours researching this trade, so therefore I believe it has to work better than it should, right? Because you've sunk that time into it. And so yeah, this is a super common one. Costs already incurred, cannot be recovered. So people are like, well, I might as well just put more cost into it, right?
That's the one that is you value your own thing versus
right,
like the pen and the what is the pen and the mug
pen
thing?
And the mug. Yeah, people. As soon as something was declared as theirs, it had more value than it should have, right? And again, with trading, I always want to bring these back to trading. I don't want to get out of this stock because I've held it for a long time. Maybe the stock's made you a bunch of money. Like you feel the need, you almost feel sad when you sell that stock, even though the whole purpose is just to get in, make your money, and get out. Because it was yours, the longer you have it, the more this effect takes place. It's big when it comes to people who hold trades for long periods of time and then look to get out. It's harder for them to come out, get out, and take the money. So I think this is more important than most of the other ones. That's it.
Oh, I didn't
That's
do
your
too
test.
bad.
You didn't do too bad, right? You're good with the biases, which I would say is the most important part, because the whole point of using statistics for trading for me is I back test and I do all this, but I know for your trading that you're not interested in that. So that's why we kind of glazed over that stuff. That's also what I teach in the mentoring when I talk to clients one-on-one, go over that kind of stuff, because a little bit more nitty-gritty type information. But so you got your biases done, but no, so next we're going to go, because everything we've done so far is stocks, right? So we're going to talk about ETFs, options, futures. I just want to more expose you to these, because there may be things that you like about these better. Things like futures, and we'll go over this kind of ETFs. There are people who gravitate not to individual companies, but they gravitate more to like sectors or ideas as a whole. So we're going to go through that a little bit, and then we're going to go into actual building of a trading plan. So we're going to talk about risk management, stop loss, hold times, things like that. That will probably be it. And then this plan is Jess is going to start her own kind of paper trading journey. I'm funding a small account for myself, and I'm going to give her a little section of that account to make a trade or two a week. So we will, this back to basics will kind of transition into kind of a weekend wrap up of how your trading went, both paper and otherwise, and more of a learning as you go as opposed to just a lecture style type of thing. Okay, guys, we will see you next week.